I'll always go back to this and say to people, whatever you know about Michael Saylor is wrong. It's just wrong in terms of the company, the whole thing.
In today's video, we're diving deep into the latest insights from Jordi Visser, the CIO of Weiss Multi-Strategy Advisors and one of the most respected macro minds on Wall Street. Whatever you think you know about Michael Saylor is probably wrong. He recalls how, during the dark months of March, April, and May 2020, while the world was in lockdown and central banks were printing trillions, Saylor was one of the few voices warning about the long-term consequences of this policy.
I'll always go back to this and say to people, whatever you know about Michael Saylor is wrong. It's just wrong in terms of the company, the whole thing. I consider myself someone who likes to learn from other people and podcasts and reading and all types of stuff. When I got where this point went, where I think it's really important is during COVID, the fact that everyone didn't take the time that they had on their hands and really focus on what was happening with crypto, why it was going higher, and start to ask the question, am I missing something important here? The biggest change that's happened, in my opinion, breaking from historical correlations, is that the stock market is called a bubble, but sentiment is near all-time lows. Like that should be making people go, what's going on here? And for me, if I didn't spend time listening to Michael Saylor talk about what the government was doing to our future in March of 2020 and April in 2020 and May of 2020 and the following year by printing all of that money, the reason we have a K-shaped economy is because we printed money to make assets continue to go higher. We gave people money, which they spent in jobs that should have been, could have been saved and everything, but people were YOLOing it and all this stuff. And so now when the whole tide goes back out, AI is taken off. AI is just the end result of what was happening from the dot-com bubble build-out. The dot-com bubble build-out allowed for the smartphones. It allowed for the cloud. It allowed for all of this disruption of jobs. Michael Saylor talks about that. Jeff Booth talks about it. It's something that as a macro person, I needed to hear, which is when you print money and you allow innovation to go at this fast pace and Moore's law kicks in, it's meant to eventually displace jobs. And so Bitcoin relative to housing, if you took all of the money that you got from the government and you put it into Bitcoin, I don't think people would want to know what it's worth because Bitcoin was down below 10,000 and now it's at 125. So if you put that money in Bitcoin at that point, it would have gone up significantly, much more than the housing went up, much more than your food prices went up, much more than all this stuff. So I think the problem is you get a massive surge in inflation. So your costs are reset higher. You get all this money for your job. And guess what? You spend it all. You're playing catch up from that point on. And I don't think that people fully grasp that that event had a huge impact on the way that this debasement trade is going. I think people are finally starting to understand the majority of the country, which is why we're going to have an election in New York City. And now he's up to 89%. Young people can't afford to live in the city that they want to live. And their parents are worried because they're having to help them with being able to live and come out of school where now they're not getting hired out of jobs. It's a very, very combustible situation for the young people. So debasement to me all starts back there. And what Bitcoin and gold are part of is the fact that if you're just going to keep printing, I need something that isn't paper. I need something that actually can keep up with the assets that you're forcing higher to keep us when we have a time of debt. It's all linked together, but to me, it really comes back to COVID and this whole sentiment thing for younger. Two credit events over the last 2 months. It's really been over the last 40 days. Tricolor, which is an auto lender for cars, again, subprime. And then First Brands, which is a parts supplier. Both of them involved in the car market, and both of them they're being investigated now by the feds for fraud. So you've had two events. They've both led to bankruptcies. In the case of First Brands, which is a very large one, it has brought in Jefferies into it, who was involved in it. I think their stock is down 20 to 25%. So when you have a bank that falls that much, you're starting to get some people looking around. The problem is a lot of this stuff is off balance sheet. It has a lot of Enron type kind of components to it. There's apparently about $2 billion of cash missing. So think about what FTX did to the crypto market.
Despite all this stress, Visser points to one positive trend, and it's one Bitcoiners will love. For the first time in history, the two best-performing assets of the year are gold and Bitcoin. He emphasizes that this isn't a coincidence. It's the market waking up to the fact that the system itself is being debased.
This has gone into the private credit world. And so private credit world has been viewed as a bubble for at least the last 5 or 6 years. Now, I don't think this is going to turn into something, catastrophic, but it does highlight the risks inherent in an economy that has commercial real estate market that's horrible, housing market that's horrible. Those are two areas with lending. And even though the housing market has tons of equity, the commercial real estate market's not great. The auto market's not great. You've got people defaulting on student loans. You don't have a great economy for the bottom 50%, and this is directly related to subprime. So I think people should pay attention to private equity stocks are selling off relative to the market, all of them. So I think there's about 6 or 7 listed private equity companies. They're falling. BDCs are falling as well. So funds, income funds, they're all kind of getting hit here if they owned any first brands. And so you're getting this little thing where, okay, it's not a big deal, but then you look for the contagion. Junk spreads have widened out like, I want to say 15 of the last 18 days. Again, nothing catastrophic, nothing that says this is a major problem. But when you're in a market that is, let's say, hasn't had a correction in a while, and I think we're going since August 1st without a 1% correction in the S&P.
Crazy.
Yeah, it's a long time. So that's an issue where it's kind of like if it hasn't rained for 30 days, you light a match, everything can go up. So it doesn't.
Can we go 100 straight? Can we get a 100-day streak of not down 1%?
Can we? Of course we can. I don't think we will, but of course we can. But there's one other thing going on that I just want to, make known to people. So I'm a derivative person by training. I spend a lot of time on correlations and a lot of time on factors. The hedge fund that I was at, we did market neutral. So I followed factors a lot. The factor world has been, let's say, showing signs of stress as well. And what I mean by that is the most shorted stuff is going straight up. And the things that have good fundamentals, quality stuff, has been underperforming. Now, this has been going on since June, but it took another leg at the exact same time as Tricolor ended up being an event. And this is the way contagion goes. You need leverage. There's a lot of hedge funds, especially quant strategies, that could have been in that trade. And then on the other side, another part of their book may have been a long short equity quant strategy. We're seeing signs, and it's been about, I want to say, almost the exact same amount of time, but in particular about the last 10 days where it's been fairly violent and fairly consistent. I can do an overlay chart, which I'm going to show in my video, which shows these types of positions, like the shorted names versus the S&P. It's a big move higher. Now, the last time this happened was in 2020. We had a similar type event, and that led into GameStop. I think you have a situation here where the market structure is kind of shaking a little bit. And I would expect that unless it starts to change, you're going to start to see more volatility in the space. So the second that we have a 1% correction in the S&P, I think that's going to be the trigger point of more liquidations for a week or two. And I think Charlie Bolello put this out this week. Yeah. And again, he's on my X list and I'll look, but for the first time, and obviously in Bitcoin's history, the number 1 and number 2 assets are gold and Bitcoin year to date. The reason that's a problem is as much as, it seems like people would own gold, the majority of people do not own gold. The majority of people do not own Bitcoin. I think with the changes we're seeing, like Morgan Stanley has their global investment committee has approved crypto. And I think they said an allocation of 2 to 4% makes sense. They did put a disclaimer I love, which is, but we'll be very aggressive with rebalancing, meaning if Bitcoin goes up a lot, we're going to sell out of that and rotate back into the others. I think the problem is bonds have been a horrible investment relative to inflation. Stocks have been good, but it's been more about global stocks this year where people are not as overweight as they are in U.S. stocks. And U.S. stocks have been okay this year. But again, I think when we talked last week, at the peak this week, I think Bitcoin was up 33% when it got to 125 year to date. Well, at 33%, the S&P was up 15%. So you're still doing 2 times this year. So I think this is a way for the banks to kind of edge into. I think you need to have the debasement part of your portfolio, which would be gold and Bitcoin. And I think this is a way to get the FAs to have the conversation. That would be my guess, because it's funny. And I posted something about this week. For every person saying that AI is a bubble or that the stock market is a bubble, they're also positive on gold, and they don't say that's a bubble. Mm-hmm. So it's like, okay, the miners are up over 100%, but that's not a bubble. So the irony of all of this stuff is, for people who are bearish, they've accepted gold. I think for people sitting at home that are retirees and people that are doing asset allocation, I think the debasement part of the portfolio, which, you know, to give him credit, I mean, Darius Dale's talked about this forever. He's had gold and Bitcoin as a big part to replace bonds. You need to have some of that. So I think this is the bank's way of kind of catching up to Darius.
We're entering a period where trust is the rarest currency. And in that world, only assets that exist outside the system will hold their worth. Bitcoin is the digital expression of that trust. Gold is its physical mirror. Together, they form the backbone of what Visser calls the portfolio of the future, the only defense against the slow but unstoppable wave of monetary debasement.